What is going on, YouTube Nation? This is Darth Dividend. If you are new to my YouTube channel, make sure you subscribe and hit the notification bell so you don't miss future videos. And if you like this video on the Fundrise Friday videos I post, make sure you give me a like so that more dividend investors and more people interested in learning how to make passive income can look at Fundrise as an opportunity to create passive income. Thank you for being amazing subscribers. So let's look at this. So last week I did say that I would post a video about what Fundrise is saying, how they plan to invest through the crisis. So this was on May 7th. They said in our latest letter, we walked through our strategy to take full consideration the impacts of current downturn as we make new investments. Key takeaways: as generally occurred in the past recessions, we expect that attractive opportunistic investments will begin to present themselves, but this is likely to take time. Given, okay, that's very honest. So patience will be key. Yes, I agree with that. I think being honest and being patient, they are being very honest and patient. In the immediate term, the investment plans will primarily be allocated to newly launched funds so that we're able to proactively pursue investment strategies that take into full consideration the impacts of the current downturn. Generally, we expect that there will be broad phases of our investment strategy over the next 12 to 18 months. By the way, dividend stock investment analysis, I am drinking Schweppes, and that was a fantastic video and collaboration that we made with Coke versus Pepsi. So a lot of you guys that watch my Fundrise videos, make sure you check that out. I have a Coca-Cola video, and I pleaded my case that I believe that Coke is a better stock than Pepsi to investors. So don't forget to check that video out as well. So phase one, maximize near-term flexibility. So public markets and structured debt, that's their target through phase one. Phase two, maintain stability and increase yield. And distressed debt and private market rescue bridge loans. Capitalize on opportunities for higher potential return in phase three, undervalued properties that we intend to hold long-term. Great. So that looks pretty promising, very honest. Although the long-term impact of the bug, which I can't say, on the broader economy remains highly uncertain, we continue to believe that the potential for a deeper and more prolonged recession is much greater than the stock market, and many of its commentators appear to be anticipated at this time. I mean, the layoffs and everything. I mean, I somewhat agree with this because people have been laid off like crazy, and there's a lot of businesses filing for bankruptcy and everything. So I do agree with that statement. While the primarily peak of new cases throughout the country may be behind us, and they put in parentheses, and therefore the nationwide shutdown may be slowly begin to ease in certain areas, the risk of ongoing series of localized outbreaks that result in second wave of a steady buildup of new cases seems highly probable. These outbreaks will likely require further shutdowns, which in turn will put broadly sustained downward pressure on the economy. Okay, real quick, I was just texting Matt Ramey and Stock Investment Analysis on a article that I found. I found this very interesting, and being a registered nurse and working on floors with the bug, which I volunteered to help out my fellow coworkers and friends. There's an article that was just posted on May 14th about T cells found in patients bode well for the long-term immunity. I'm actually going to post that link in the description because, with these findings, we're finding more about this bug than before. Now, if China was straightforward and said, oops, we screwed up, and if they're kind of pulling off an Enron, remember Enron? They finally said, we kind of screwed up. They kind of knew that there were issues, and they didn't say anything until last minute. That could be the issue. There was just an article out in the state of Ohio that I live that the first patient was actually in January 7th that they found. So now, and in France, they posted a link in an article, but I am going to post this article. I find this very helpful for the dividend investors community and people that invest in Fundrise or are interested in investing in Fundrise. I am going to post this link in the description. But here's the thing, okay? yes, there are things going on, but more research is coming out. We are knowing more about this bug. We are knowing more about the capabilities, and we are antibody testing more people. So this is the big thing. We know the target population to protect. Unfortunately, I think the Gallup, in my honest opinion, I think the California governor jumped the gun with a lot of things. So this, with this issue, and this is my honest opinion. We will model and see how Georgia is doing and how Florida is faring. So California kind of jumped the gun, just said no, no this, no this, no this, no sports, no this, no this. They're holding off everything until September. So this is going to be interesting. Hopefully, with more data, we can all jump to a conclusion. And as more healthcare providers collaborate and as the world collaborates, I think we will find a solution. So they said additionally, bills continue to pile up in spite of the fact that much of the country has been suspended animation the last weeks. Notwithstanding various government stimulus programs, most businesses have been forced to temporarily close or had to carry some payroll or healthcare costs. They may be delayed in paying their mortgage, rent, insurance, utilities, and local taxes, but those expenses have not been forgiven. More than likely, they have outstanding payments to their vendors. When the economic clock starts up again, these accumulated bills will come due to many businesses will not be able to pay them. The market is in a complex chain of relationships, one company's expense and another company's revenue. So that's like one issue with WestRock. I posted a video about WestRock, about how they had to cut their dividend because they're a big supplier and stuff, but people just really aren't shopping. So why should they really why should they really pay us dividends? And that's a risk with dividend investing, but I feel very confident in WestRock. So if customers are afraid to go out and spend, restaurants and retailers won't earn enough money to pay their suppliers and landlords. That is correct. That is an honest and that is a very valid point. And if suppliers are left without unpaid orders, they will be unable to make payroll. That is correct. And if tenants cannot afford to pay the rent, landlords won't be able to make their debt service payments to the bank. And if the banks are afraid that their borrowers won't make their loan payments, they'll begin to stop extending credit. The very thing that other businesses need to get back up and running. Because of this paragraph that they just said, that is a reason why I invested in Bank of America. I invested in KeyBank on my E-Trade account, Huntington Bank, and a few other bank stocks that I'm considering because of this issue. They're down right now, but eventually they will go back up. Do not doubt the American machine. That's all I have to say. I'm going to take a sip real quick. While the negative impacts of such a downward spiral are numerous, and while the current disruption in the market will inevitably lead to new investment opportunities, we feel that we are still early in this process, and now is a time for caution. I would agree. I mean, real estate is probably one of the biggest sectors that took a hit. I'll probably post in my E-Trade dividend portfolio how things are looking, but I will say that eBay is looking very strong on my dividend portfolio right now, as well as some other stocks, but real estate took a little bit of a hit. I'm going to be honest with you. So real estate markets move slowly, and they say typically lagging in the public stock market. So we believe that'll take several months for the downstream effects of and subsequent response to fully work their way to the core of the economy. The Great Recession, for example, lasted 18 months, and many of the best buying opportunities in the real estate market didn't open up until 12 to 24 months after it began. Meanwhile, it's barely been 60 days since the current downturn started. So they have a graph right here, real estate buying opportunities that may lag the broader market. They just have a nice graph, to describe this. So here's the Great Recession and things hit, and then they went up. So here's April 2010, basically the CRE loan delinquency. At this point, we feel the smartest thing we can do to our investors is put ourselves in the position to act on these opportunities once they start to arise. This means both continuing to build up a larger cash reserve across the portfolio and establishing ourselves as ready and willing buyer within the channels of brokers and agents that act as a conduit for future deal flow. Unfortunately, ultimately, with the benefit of having more conservative up to this point, the cycle combined with our willingness to be patient and should afford us better opportunities to acquire those assets that we believe in general generate outsized returns over the long term. As a result, more permanent structural changes to behavior that emerged from the pandemic. Below, we walk through our specific investment strategy, which we've broken into phases. Phase one. Now, this isn't, they put in parentheses, keep in mind that the following represents what we believe to be the appropriate given as of what they know today. It's important to note that rather than occur in strict succession, there's likely to become some overlap that, depending on future circumstances, we may deviate from this strategy significantly. So they put phase one, start of the downturn, phase two, recession, the trough, and phase three, capitalize on opportunities for higher return. That's kind of weird the way they have trough, because when I think of like as a nurse, like if you do like vancomycin, they do peak and trough. So you know, that's interesting the way they diagram that. Phase one, maximize near-term flexibility in these financial crises. First major access to experience disruption in credit markets. This is due to the fact that credit is by far the largest asset classes and simultaneously exposed to the long-term economic risk and overnight margin requirements. A long bull market, like the record-setting one that ended in February, encourages a false sense of security. As we indicated in our 2019 year-end letter to investors, the Fed is in its lower for longer accommodative monetary policy, effectively signaled to the market participants in green light to take more risk. Gradually, but ever increasingly, investors borrowed the short to lend long. And when the paradigm suddenly and unexpectedly shifted from the optimism and fear, institutions called in their lines and demanded paydowns, triggering the start of a vicious doom loop of forced selling and sharp price declines. For those who don't make a living trading in them, they put in parentheses nearly everyone, credit markets can often completely out of sync with the real world because they trade with expectations of what the often distant future will bring. And they therefore tend to collapse before the real materially adverse changes take place in the economy and seemingly rebound even amid mounting job losses, reduced earnings, and even bankruptcies. For this reason, they can both be a bellwether to the future as one of the first places where opportunities to find value emerge. Let me just look at just one stock, how O is going. So realty income's actually down, so the market's actually taking a hit. So this is what they're saying. Realty income's down 2.88% right now. So what we long believed for the general stock market was overvalued due to a correction. We believe that certain assets, such as a high quality credit, the recent collapse in pricing was driven more by lack of liquidity than by weakness of underlying fundamentals. In some instances, spreads for high-grade borrowers have blown out by hundreds of basis points, while underlying assets remain more or less stable. Although spreads have begun to normalize liquidity returns, we believe there's an interim opportunity to deploy a proportion, I can't even talk, of our existing cash reserves and now near zero yielding money markets to specific more liquid securities such as rate bonds, where we have a deep understanding of underlying the assets and securing debt due to managing and operating very similar properties ourselves. So look at this graph real quick. So they just said opportunity to improve yield while staying liquid. So here's some rate bonds trading at spreads versus treasuries. Today, some of these rate bonds, which effective LTVs approximately 40 to 60%, are pricing at the 200 plus basis point spreads above the US Treasuries. And then they said a basis point equals 1/100th of a percent. So the aforementioned bonds are trading at a price that yields a 2% premium to the US Treasury note. By comparison, the same bond was trading at a 50% basis spread only for a few months earlier. We believe these bonds with increased spreads represent a prudent interim investment today that will generate yields superior to money market funds while providing a near-term flexibility when we determine its appropriate shift into more illiquid opportunistic acquisitions. So after reading phase one, I think that's reasonable and rational. Phase two, maintain midterm stability while seeking increased yield. Target investments, distressed debt, and private market bridge rescue loans. As the shock of the abrupt shutdown continues to reverberate throughout the economy, we expect that some real estate assets to be impacted will be projects that are midway through development. This should include properties that are still in the process of completing their entitlements or even buildings that are under construction. Either way, the combined impact of the shutdown of non-essential businesses with rapid change in the commercial lending environment is likely to produce a cohort of projects that are behind schedule and in need of additional funds to reach completion. In certain cases, these projects may not have inherent flaws or weaknesses, but are simply the victims of poor timing and circumstances changing beneath them. Even experienced developers will often only capitalize a new development with a 10% contingency for timing delays and cost overruns, leaving little room for the unexpected. Many of these projects will need short-term additional funding in order to ensure that they are able to deliver. Due to the existential nature of not completing a development, says half-finished building isn't worth much. The value of these additional funds tends to be extremely high. While most likely the source of additional funding should be capital calls from the existing equity investors, some of these equity investors may be unwilling or unable to step up to the plate, in which case a sponsor would then need to look to external sources to rescue the project and bridge its completion. In these instances, a combination of substantial cash reserves, along with our experience as an operator and investor in similar projects, should put us in a compelling position to recapitalize select projects that we believe in the strongest fundamentals. Since the liquidity provided our cash reserves tends to be scarce during times like this, we expect to be able to invest a lower basis and higher return than we would able to only a few months earlier. That's interesting. So phase three, they discuss capitalizing opportunities for a higher potential return, target investments, direct ownership of undervalued properties that fit long-term macroeconomic trends, capitalizing on opportunities for the direct acquisition of assets whose prices have come down substantially below where they were trading previously will have the longest tread time. This primarily due to the fact that most instances, unless an existing owner is truly distressed situation, they are unlikely to sell an asset for substantially less than what they expected to receive before the downturn. In other words, external events must force a sale. In this case, distress would likely come down from owners who have over-leveraged the asset itself or have overextended themselves as a sponsorship ownership group. To understand the natural lag to see these opportunities, take an example for a hypothetical owner of a retail shopping center in today's environment. So basically, they just gave some examples. So what does this mean? So this is what they said. In summary, even for assets, failing retail shopping centers are likely to experience the most immediate and substantial negative impact. It would take 12 months or more before an asset actually changes hands at a distressed price. So this is what they said. Some examples, okay? Due to the shutdown, most of all tenants in the center are closed or at minimum providing delivery-only services. Few are generating enough revenue to afford to pay their rent, and the owner is probably willing, if not required in certain states, to extend several months of rent relief to the tenants. Maybe 3+ months before the tenants are fully open for business, and once they do, it is unclear if many will actually be able to survive, having drained much of their cash reserves. With and with customers potentially choosing to continue to do a majority of shopping online. During a painful 6 to 12 month period, as stores and income from their property deteriorates, the owner will struggle to cover their debt service repayments to their lender. As a series of short-term extensions and potentially last-ditch ever infusions from the owner in an attempt to stabilize property, they might finally determine it is their best option to sell their asset at a substantial discount to their basis, or simply give the asset back to the lender in foreclosure. So much like Warren Buffett, they said, we believe it is better to buy a great real estate at a good price than a bad real estate at a great price. So we will focus our efforts on assets that we believe to have the strongest fundamentals and long-term growth drivers. So basically, this is what they said to everyone's portfolios. In the immediate term, the investment plans will primarily be allocated to newly launched funds so that we are able to proactively pursue the aforementioned investment strategies that fully take into consideration impacts of the downturn, as well as natural timing for private real estate markets. While I have a blank state in which to invest providers flexibility necessary to execute these strategies, it also means that these new dollars invested through the plans will be going into funds with only a limited number of assets for some period of time. In addition, relative variation between our income and growth focus plans is likely to be less pronounced during phase 1 and 2. We seek to deploy those assets and provide investors with the greatest stability and flexibility. As we eventually move into phase 3, we expect these plans to diverge as more as income funds will likely continue to hold some of the longer term income focused assets, while the growth funds will likely allocate out of the short term liquid assets to provide potentially undervalued or distressed assets that may have very little yield during the period required to fix or rebuild the asset, but with much higher potential returns should that work to prove accretive. Let's see what else. What is the best thing that they said? So basically, while investing with Fundrise, it always has been a long-term proposition, which they have written about, and this is why I invest in them. We expect the current environment to require given a greater level of patience from us if we are to fully capture the opportunity created by the moment. Fortunately, because of the strength and size of our overall portfolio, as well as our opportunity to deploy into certain types of institutional grade public and private market assets, we believe that we'll be able to deliver our investors a strategy that otherwise would be available to them as individuals. As always, our unique advantage comes from our 130K strong investors community and the ability to collective force to come together and direct auction for the benefit of the whole. So look, I'm going to give you my response. One, let me take a sip real quick. One, okay, this is why I'm not an individual real estate investor. All this crap that is being, thrown at real estate owners is it's a lot. I mean, this is a lot of terminology. I don't have time to look into stuff. I'm going to be looking at graduate school. So this is why I invest in real estate investment trust and Fundrise. Fundrise pretty much actively manages my portfolio. I put money in and they do the work. So, money makes money. A lot of us are not business majors or really have a lot of knowledge with real estate. So this is why I'm taking a risk with Fundrise and why I really like my balanced portfolio. I think this is a very strong article. I know this is a long article and I've been reading and sounds like I was pretty much babbling, but look at this. So, they're being honest. They directly said what their phases will do. And, things are going to be hit hard, but I'm going to be honest with you. This is why I invested in I put more money in store capital, because they're a very diverse portfolio like Fundrise. And there's just, a lot of potential. I know. And the other thing is, like with banks taking a hit and with real estate taking a hit, the market always fixes itself. These people are smart. These people know what they're doing. They've been around. I mean, this is Fundrise's first test at ever happening. So this is when you do, when people discuss videos on Fundrise, this is the first time they've really been challenged and hit with a curveball. This is something that really threw them off. And this is something that they're trying to adapt to and change. So this is what I like about Fundrise is they're very honest about what their plans are, and they're telling us as investors what their strategy is. And I know they're trying to sell pretty much, this is why to stay with us. It's in for the long term with the Fundrise. So I mean, this is why I invest in these guys. I mean, sure, you can generate a lot more money owning your own real estate, but I can't just in the middle of my shift as a nurse just say, "Oh, I got to drop everything." I'm in the middle of a code, I got to drop everything. Somebody's pipe leaked, and I'm a real estate owner. I own a house, so I can't do things like that. I'm never going to leave my patient like hanging like that. If something happens, I don't have the money to hire a bunch of people to run a real estate. Now, if I'm in a pool or something, that's a different story with a bunch of investors, which I'm not an accredited investor. But, the thing is, I don't have the money and I don't have the time to try to build my real estate empire. And this is why Fundrise is giving us an opportunity in a crowdfunding platform to earn passive income and have a way to make passive income and be successful. So everybody wants to make money. I don't care what you want to say. I mean, I think last year at this point was when I started making YouTube videos. We're like really active YouTube videos, and I changed my niche to investing because it doesn't matter what field you're in. If you're in healthcare, if you're in this, that, these, or those. I mean, there's a reason why I invested in Fundrise and why I changed my niche to investing. I feel very empowered, and I feel, with networking with a lot of you guys and, messaging each other on Instagram and texting each other and learning more about stocks that people own. I mean, there could be things that I don't even know where I'm not even informed about. And because you guys have videos or people are discussing things, again, we're not financial professionals, and I'm not a financial professional, and I can't give professional advice as I have disclaimers in my videos. But, this is something that, is great about Fundrise. It just gives you a chance. I always had this thought process. I want to be what if I could own real estate? I don't have the money. And then all of a sudden, it was like 2 years ago. I was like, oh man, how do I make passive income? How do I get extra sources of income? Some articles I started reading started scaring me that 401ks weren't enough. And, I did some searching, then I found Fundrise. So, I was very, it's kind of a weird thing. I just ran into a guy at a beach and he started chatting me about how to make money and how he's doing and how successful he is. And I looked at him like, I don't have the money. What are you talking about? That would be awesome. And then he showed me, ways to make passive income. I didn't pay him anything, but I was very thankful of him. So, things can change. You have an intelligent conversation with you, things can change pretty fast. So my life changed when I started to become a dividend investor. So, my mentality, my focus, and my energy, it's there. So I'm a very laser focused individual on anything I do, and Fundrise has helped me and empowered me to be a smarter investor and a more patient investor. That's the thing about becoming a dividend investor. It's about discipline, being patient. So thank you for watching this video. I know it was a long one. I gave my response to this article. Let me know what you think about this. And if you are new to my channel, and if you guys are Fundrise people. I always try to get videos right around Friday. So you'll see the hashtag Fundrise Friday. Just search that on YouTube, and or go on my Instagram and find that, or just look at my channel on Fridays in my comment section or my discussion, or just, you know where to find me. Just search Darth Dividend and look at my videos. So thank you again. You guys have a great weekend. I hope the worst is over with this pandemic. Again, I will post that article, which shows a lot of promise. Again, I'm not a epidemiologist or a medical physician or anything, but this article has a lot of promise to it. So I will post this in the article in my description, and go from there. So you guys have a good one, and have a great weekend. And thank you again for watching this video. And if you like this video, make sure you give me a like as well. Thank you.